and welcome. In just a minute, we are going to be discussing the effects of elevated interest rates on banks, businesses, and consumers alike with one of our senior financial advisors. His name is Wesley Boudreaux. And if you stick around after his presentation, he will also be answering some questions. Before he comes on, though, I'd like to very quickly remind you that we are not affiliated nor endorsed whatsoever by FedEx. The retirement group is a completely separate entity. And if you happen to see any YouTube cards popping up on your screen while you watch this video, feel free to give those a quick click. They're going to guide you to several different resources we have available, one of which may simply be another video, a past video that might be of interest to you as a FedEx employee. So take advantage of those. And without further ado, here is Wesley Boudreaux.
Hi, Wesley.
All right, thank you. Appreciate that introduction, Samantha. And like she said, we're going to be talking about something a little bit different than what we're used to talking about. Usually we go into company-specific details, but we're going to talk about kind of the economic conditions in general, what we're potentially seeing here for 2024, some of the headwinds, some different job situations we've already seen happen. And then we'll also talk a little bit about the banking crisis last year, not crisis, but some of the banking issues last year. And some of those are continuing, it looks like, unfortunately, this year as well. So jumping into it, again, like I mentioned, the current landscape, we're going to go through that. We'll talk about the interest rates and kind of impacts of what we'll see with the Fed reserves, whether they're going to continue to keep the rates steady. Are they going to drop those? What's the likelihood of that dropping? What's the likelihood of a potential recession versus soft landing? But right now, there's a lot of headwinds still we're looking at for the economic future for 2024. Some of those different things would be, again, the monetary policy. We've seen those rise in interest rates over the last year and a half or 2 years or so. Honestly, kind of quite surprised we've had more of a soft landing so far. And a lot of that's because of some of the different, pent-up demand post-pandemic. There's still been, even though there's job cuts, there's also job opportunities scattered across America still. What we'll see is it feels like we're slowly kind of trickling through that monetary policy. So we should still see some potential slowdowns, but hopefully not a recession here. There's still obviously geopolitical risk, dealing with Russia, China, Middle East situations. The consumer, given all these interest rate increases, the inflationary pressure we've seen, has been fairly resilient so far. We may see the consumer start to bend, hopefully not break, but bend and be a little bit more cautious about the spending. But hopefully the goal is that that inflationary pressure has kind of slowed down. We'll talk a little bit about that later. But it doesn't mean that we haven't erased the the rising costs that we've seen over the last 2 years or so. And again, like I said, unemployment is a little bit higher. It's expected to be a little bit higher, but still well within long-term averages. So that's still a safe situation. But we'll talk a little bit about some of the job cuts we've seen recently and some that may be coming forward as well. And then, housing situation, we've seen a pretty big drop in that over the last 18 months or so. I think about 30 to 40% drop, given obviously the rising interest rates. Those rising interest rates also are affecting the commercial real estate market, which is going to be part of a discussion we'll have a little bit later here, and how that's affecting mostly regional banks, because it's usually regional banks that will lend out money to commercial real estate development. But right now we've got, I think it's about close to 500 billion that's actually coming due in this year for where the rates will be reset. So a lot of that's going to be a situation to look into as well. The Federal Reserve, their job is to obviously create that soft landing, which, like I said before, they've actually done a pretty good job. And a lot of that has been with the help of, like I said, pent-up demand, supply chain issues, where usually what we'll see is rising interest rates will affect, the auto industry, but not quite as much because we've had pent-up demand because there was a lack of supply back during the pandemic. So a lot of these things are kind of, coming into a situation where we may see some adjustments and some of those monetary policies finally trickling in. The goal for the Fed is going to be to actually try and, again, create that soft landing. Right now, they've got the Fed fund rates target at that 5.25% to 5.5%. We will see if they lower those in the coming months or so. Expectations are that we should start to see a reduction in those interest rates coming around the summer months or so. A great tool that's actually used is a CME Group puts out a tool that gives you the essentially what it does, it runs the futures market and the interest rates. So it's taking a look at what traders expect to happen. And so far, it's been fairly accurate as far as the Fed almost using that in order to make their decisions, because they're seeing what the market wants and what the market expects. But right now, we've got, I think it's about a 97% chance of no changes in the next March meeting. Then that's going to change to, I think, about 70% chance of no changes or so in the May meeting. But then we get into the summer months in June and July. It's actually flips. There's actually about a 70% chance or so of them starting to drop rates in June, and it goes up to, I think, close to about a 90% chance last I looked, maybe 80 or 90% chance of them starting to drop those even more in the July months. So this could be good, it could be bad. The target is usually 2%, and what you're going to look at is the Fed wants to keep that target around 2%. But again, that doesn't negate anything that's happened over the course of the last couple of years. That doesn't reduce prices. That would be deflation. So again, if you had the cost of a hamburger was $5, and let's say if it went up 10% for 2 years, let's say that went to $5.50, then a little bit over $6. Even if inflation stopped, you're still paying 20% more, $6 for a hamburger that cost you $5 2 years ago. So keep that in mind. The goal or the fear is we want to continue and avoid a recession. But a lot of times when interest rates start to decline, especially if they decline significantly, that could be a sign that a recession is around the corner. Historically, we've seen this when interest rates drop, we tend to see a recession afterwards. But again, we'll keep a watch on that, and hopefully, again, the Fed does their job and there's a soft landing here. So another thing that we've seen is some different issues with the job markets, different layoff situations. We'll talk a little about the New York Community Bank, their crisis they're going through here in the first quarter of 2024, and some of the factors that led to that, and how that could be some factors across the board for other situations as well. But right now, we've seen tens of thousands of job cuts already in the first quarter of 2024. A lot of this is coming from the tech and media sector, and a lot of it actually is, you could say is induced from the growth of AI. Actually, there was a study, I think it was about 900 different firms and those that are responsible for recruiting and hiring said about 4 out of 10 said that they're either looking at hiring freezes or reductions because of the potential that AI has already brought on board for them. And you're also seeing a rising trend of I shouldn't laugh at this, but a rising trend of people actually documenting their layoffs. So you may have seen this last year, and you might still see some more of it this year, where people understand and know they're going to be getting let go, and people are either recording those phone calls or doing TikTok or YouTube videos about it. So it's definitely a trend. But again, what we've actually seen is there are other jobs still out there. It just may not be in your specific sector. Like I said, tech's been the one that's been hit hardest. Media companies like Amazon, Google, Citigroup actually announced significant layoffs. Even UPS, Citigroup, I think it was 20,000. UPS about 20,000. Some of these are pretty significant impact. But like I said, most of them are going to be in the tech industry. We had about 260 some odd thousand last year. Already about 65,000 announced for this year, as I mentioned before. But going forward, we could continue to see some of these job cuts. But like I said, it's a combination of some cases AI bringing in the ability for some of these companies to work without those employees in certain areas. But a lot of it's also going to be kind of post-pandemic. We had a hiring feast, if you would, after the pandemic, where companies needed people for that rebound. They had to overpay them in some cases to get them in there. So now that's kind of working its way through the system. They're understanding the cost associated with that, and they're able to lean up and actually reduce some of their headcount in order to kind of go back to pre-pandemic type levels as well. Now, another issue that we're coming into is we saw some of the banking issues about this time, February, March of last year. When we're starting to see it again, unfortunately. And this is really kind of geared around commercial real estate. But New York Community Bank is one that is going through a crisis right now, where we saw back at the very beginning of February, their stock price plummet by about 40% or so. We've actually just seen it here kind of rebound a little bit, and then it's dropped again quite a bit just in the last day or so. And a lot of that's coming on the aspect of taking a look at their books. So they were one of the ones that actually bailed out Signature Bank last year. And one of the things that happened was by bailing them out, they're taking on their assets under management, but they're also taking on a lot of their bad loans. And a lot of these loans are coming due and they're needing to be refinanced at higher interest rates. But one of the biggest issues was because they took over this bank, took over Signature Bank, they brought in their assets. So what that did, that rose their assets under management. And by getting over 100 billion, that also rose their requirements for the Federal Reserve, and as far as what needs to be kept in reserves. And so that changed a lot of different factors for that company. And but it was as easy, I mean, excuse me, as recent as January, where they're paying very high dividends and everybody had them tout it pretty well. And then, you know, once these started coming due and we're starting to see this, then you're seeing it take effect. Now, again, this is commercial real estate leading to a lot of this, and usually it's regional banks. So we're not seeing this, you know, amongst the big national banks, but again, it could trickle in as we see more of these loans reset coming forward. I think I talked about some of this already here. Again, a significant portion of their portfolio was in commercial real estate loans, and those refinancing situations are driving some of this. But you know, they've come in and they've had to readjust, and they've had to increase equity or have a call to increase equity. And again, similar to, just to kind of hopefully calm some fears, similar to what we had last year. A lot of it was driven by interest rates. It didn't mean that the banks were necessarily insolvent. It just meant that if there was a bank run, and I think of It's a Wonderful Life when I think of something like that. But if there was a bank run, then they wouldn't necessarily have all the assets available in order to pay out immediately. They'd have to sell some of their assets, and by selling some of those assets, they would sell them at a loss because interest rates have gone up and they're higher, which would reduce the what somebody would be willing to pay for one of those assets they have that maybe paid lower interest rates in the past. Okay, so we'll see if this kind of trend factors in the rest of the year or so. Hopefully it does not, and hopefully it's going to be mitigated. But like I said before, in looking at this, going back in January, you know, New York Community Bank was touted as, you know, having a great dividend. I think it was maybe 7.9% or something like that, and touted as a great value buy. And then, you know, fast forward just a couple of days later or so, that we saw that precipitous drop. And then a lot of people said, it's an even better value buy, but now we've seen it drop even further. So in summary, just be very careful about individual stock investing. Again, you know, the retirement group, we focus on value investing. You can look up one of our webinars to go over that, or give us a call. We do tend to focus on margin of safety, trying to protect the principal in the stock portfolios that we do run. But you want to make sure you're diversified. You want to make sure that if you are looking at individual stocks, you do your research and do your homework. Even then, you may not have all the information that you need. And you need to be focused on staying resilient in different times like this. I'm not trying to paint any, you know, doom and gloom picture. Chances are it looks like we're going to kind of transition through this fairly smoothly. We've actually had a fairly decent run or increase in the S&P 500 here so far year to date. You know, typically in the fourth term of a president cycle, we tend to have muted growth. So we may see kind of just ebbs and flows here into the election, but obviously, depending upon your take on the election, we could see some different changes leading up to it or post-election as well. But the best thing to do is go ahead and review your overall portfolio and make sure that's in line with what your goals are. And the best way to kind of run those goals is not just say, hey, I'm a risky investor or I'm conservative, but it's to actually run a cash flow analysis or a financial plan. Right now, about 3/4 of Americans over 50 don't even have a written plan. One of the things we do provide at the retirement group is a complimentary cash flow analysis, especially beneficial for those of you that are you may be a couple years out from retirement or 5 years out from retirement. You want to see, hey, am I on the right path to retire? Can I retire when I want to? Should I, you know, increase my savings? Do I have to decrease my spending in retirement? We can go through all those different aspects, and once we have that answer, that can then lead into, okay, how should this portfolio be allocated? Should you make any changes in your 401k? Are there better options in an IRA? We can go through all those different choices with you, but it's best to get a plan together to do that first. Now, I know we kind of jumped in the update and left some of this information for later, but again, for those of you that do not know who we are, the Retirement Group, we are an independent financial advisory firm that focuses on working with mostly Fortune 500 companies and helping their employees transition into retirement. A lot of these companies, our advisors work specifically with maybe only 3 or 4 or 5, so we have a deep understanding of your specific benefits plans. So rest assured, if you got questions, we can go through everything from the pension, the 401k, healthcare retiree medical benefits, life insurance continuation, things like that, and make sure that you understand as you transition how you can maximize those benefits from your specific company. We do have offices throughout the country, so we can probably accommodate you in person, but obviously this day and age, it's very easy to have a lot of web meetings or phone calls, whatever your preferred communication is. Just let us know. But again, that cash flow analysis I mentioned before, that is complimentary. So if you have any questions, want to dig into what your situation is, go ahead and take us up on that, and we'll be happy to dig into it for you. And I'll see if Samantha, we had any questions come through, but while we do that, I'll leave this up here. There's a couple QR codes on there if you want to get into our LinkedIn page to stay updated on your specific company plan information, or if you want to schedule an appointment with myself or one of our other advisors, you can get into our calendars there as well. And you can always reach us at info@theretirementgroup.com with any questions, or call us at 800-900-5867.
Thank you, Wesley. Yeah, we got just a couple questions. We're going to keep it short. Number one, how do massive layoffs affect the overall stock market stability?
Okay, so it's going to depend. I mean, it could come into it from a couple different scenarios. Mostly layoffs are going to affect the independent company first. So let's take a look at I mentioned Citigroup before. They made that announcement of 20,000 layoffs back, I think it was the second week of January or so. Investors actually liked that because they saw they were leaning up and becoming more efficient, and that stock's up. I want to say it might have been like 8 or 9% since then. So in some cases it can benefit a company, other cases it can have a negative sentiment. But if you fast forward and say we got massive layoffs across the board, nationwide, then obviously that could have a trickle down effect, because if you've got more people getting let go, then that could reduce consumer demand or consumer purchasing power, which in turn could hurt the market. But right now we're in a point where it doesn't seem like that's an issue. I think I mentioned before, we might see the consumer bend, but probably not break. Even though we've had those layoffs we talked about, the job numbers in January were great. So again, it just may be an issue of, we got layoffs in one section, but we got hiring in another section. So it may be, shifting your focus and shifting your job mentality. But so far, so good.
Alrighty, thank you. Next one. What's the likelihood of a recession given the current economic indicators, and how should I prepare my portfolio?
Okay, so two questions in there. I mean, if you asked me this a year ago or so, I would have said there's maybe more likelihood, but like I said, it's we've actually kind of experienced or had that soft landing, or maybe not a soft landing, but a delay of that potential soft landing so far in 2023 because of some of the issues I mentioned before. Again, a lot of the expectations are for not necessarily a full recession, but maybe a mild recession or a soft landing coming in the middle of summer. So let's say, the latter part, the second part of 2024, we may see something like that, but it's not expected to be severe so far at this point. But again, like we said, there's always other headwinds and things that could change that. But generally speaking, we shouldn't see much recession. Now, as far as how to attack your portfolio, again, it goes back to understanding what your goals and your risk is. Somebody who may have 20 more years of work ahead of them versus somebody looking to retire next year is going to have different risk tolerance. So you need to understand that first, but and then look at a diversification approach. And you may want to, make some tactical allocation changes here or there, but by no means you want to go in and try and time it and get all in or all out of the market. But a good thing to be aware of is a lot of people kind of shied away and got out of bonds over the last decade or so because the interest rates were so low. We finally seen these interest rates come up, and so you've got good yields in bonds. So it may be good to look at that again, because if we do see interest rates drop, then we'll actually see price appreciation in those bonds as well, because if interest rates are lower, somebody's going to be more attracted to your higher paying bond yield that you may have right now. So again, best to give us a call and look at your portfolio, but hopefully that helps a little bit.
Thank you, Wesley. We're going to just do one more, but before I ask this last question, I just wanted to remind everybody that there are several links in the chat. You can book an appointment with Wesley. You can also use the QR codes that he has up on his screen. We'd love to connect with you on LinkedIn. Follow us on YouTube at The Retirement Group. Alrighty, Wesley, last question. How does the high interest rate environment impact my decision to either continue working or retire early?
Okay. I guess the question could go two ways depending upon what was meant by it. But if we have continued high interest rates, obviously that means we've got continued inflation and things are getting more expensive, and so your purchasing power is eroding. So just from an overall standpoint, if you want to be safer about your overall situation, work another year or two, of making income versus spending money, that could be beneficial for you. So that's just one way to look at it. But at the end of the day, running that cash flow analysis, the best way to see, you may be surprised. You may have enough money set aside. You may be able to retire sooner than you want. And the question becomes, what's the extra year or two of retirement versus employment, mean to me emotionally? But the flip side of that question, which may be what it's alluding to, a lot of the companies that the retirement group works with, they still actually have pensions. And a lot of those pensions do have what are called lump sum conversion calculations, and those are tied to interest rates. So if you're one of those companies and you're having questions about your pension taken as an annuity or a lump sum, if you're thinking lump sum, as those interest rates come down, you'll actually see your lump sum increase. So it may be beneficial to actually hang on a couple more months or a couple quarters or even a year more in order to get a bump in your lump sum calculation. But those are ones, give us a call. We can definitely go in there, and that really ties into running a pitch and estimate for you and digging into that cash flow analysis to show you the benefit of whether you leave now versus hold on for another year, get an extra year income, as well as maybe you may make an extra 50 grand or more on your pension. So it's really up to running those numbers to see that. And you said
Thanks.
that was the last question, I think.
Yeah, that was it.
Okay, so just as she said before, a quick reminder, even though I talked a little bit about some of the companies we work with, we're not specifically employed or endorsed by them, but our advisors have worked extensively with a lot of them and some for over 30 years. So just give us a call and we'll be happy to dig into anything on those and run those reviews for you. But you can reach us at 800-900-5867. Thank you.
Thank you, everybody. Have a great day.